In this video, I'm going to tell you why I think that overfunded whole life insurance is better than a 529 plan. You may have been told that a 529 plan by a financial advisor, your neighbor across the street, or Dave Ramsey, all who are qualified by the way, that the 529 plan is the best thing since Taco Bell. And Taco Bell is good. But I'm going to share with you 3 issues with the 529 plan and why overfunded whole life insurance is a way better alternative. Then, like always, we'll take a look at the numbers. But before we do that, I want you to listen very, very, very closely. This may be the most important thing that I say in the entire video. You have no idea what your child is going to want to do when they turn 18. Ask yourself the question, what did you want to be when you grew up? An astronaut? President of the United States? If you were like me, an NFL star. So you can plan for your kid's future, which is super important. But they are going to change, adapt, and mold just like the world does. The world is changing, and college is a big piece of that. So you ask yourself, well, how do you plan for your kid's college with uncertainty of the world? And let's just pretend you just had a kid. Who even knows what college is going to look like 18 years from now? So don't just take it from me. I want you to listen to Alex Hormozi here and talk about the dynamic of college and where it is at today. And if this doesn't make you think twice about college, I don't know what will.
For most people, they say college was established to increase the quality of the workforce. So increase skilled labor so that we could be more competitive as a nation. And there was kind of different tiers of workers. There was tiers of workers who didn't have a college degree, tiers that did. College at that time, from a price to value perspective, was significantly higher. So price what you pay, value is what you get. And so the return on the investment of both time and money still made sense for people to forego income for most people for that period of time. The reason college originally was started was to create a price to value discrepancy in terms of value additive to the people who went through it. And that discrepancy no longer exists. It transformed from being a value additive to a cultural norm. And so people continue to do it as a cultural norm, not because it adds value, but because they've always done it that way.
So if college is no longer a value add to the majority of society based on the cost of attending, and it is actually more of a cultural norm, where do you see your headspace in kids when it's time for your kid to go to college? Now you may argue, Dom, what about the doctors, the lawyers, the accountants? And I agree with you, but those are a very, very small percentage of the population. What are the odds your kid becomes one of those?
I think Gary Vee said something that was really profound. He said, I get it. Doctors, lawyers, accountants, you need the degree. He's like, but what about the 95% of people that aren't in those 3 to 10 buckets of career paths that are the easy ones to name off the top of your head? What about them? You know what I mean? What about the 2 million, plus salespeople that exist? You know what I mean? Just in the United States alone, like what about those people? And so, yeah, I think everything comes down to price to value discrepancy and cultural norms.
So in summary, hopefully this challenges you to think outside of the cultural norms. Although, I believe if you are already watching this video, you already think outside the box. Now, I'm not here to bash a 529 plan. I actually could make an argument for it. A 529 plan could arguably make sense if your kid 100% knew that they were going to college. But you must ask, but what if they don't? Okay, now that I got that off my chest, let's talk about some of the issues the 529 plan has. Big issue number 1, and why overfunded whole life insurance is a better alternative, a 529 locks you in for only using it for essentially formal education. If your kid decides they don't want to go to college, which a lot of them are starting to, here are the consequences. A 529 plan is meant to grow tax-free and use tax-free. If you don't use it for college, you now have to pay taxes and there's a withdrawal penalty. So I'll repeat, you must use the funds for college. If not, there are taxes and 10% penalty involved. And yes, for all you know-it-alls, 529 plan was extended in 2017 to cover K through 12 and apprenticeship programs in 2019 as well. But again, very small percentage of the population. Let's look at the alternative, life insurance. You can use your funds for whatever you want. If it happens to be for college, amazing, use it for college. If you want to use it to help jumpstart their life, starting a business, getting into real estate, doing an investment, essentially anything to help them move forward, you can. Best part, no penalties or taxes involved. Big issue number 2, and why overfunded whole life insurance is a better alternative. Lost opportunity cost. I'm gonna say it again, lost opportunity cost. You're probably asking, Dom, why are you saying it like that? Because lost opportunity cost may be one of the most valuable pieces of this entire equation. This is absolutely huge. You don't just spend $1, you spent what that dollar could earn you for the rest of your life. If you have this big pot of money and you spend it on college, that money's gone forever. You exchanged a service, and not a very good service in my opinion, for currency, and that dollar is no longer in your possession. Inside life insurance, you aren't actually spending or using your own dollar. Your dollar gets used as collateral, and you get a loan against that collateral from the life insurance company. So here's how it works. You have money. You give money to the life insurance company. They hold your dollars as collateral. They give you a loan against that collateral. You then take those dollars and go buy cash flowing assets such as real estate. That real estate produces cash flow, which goes back to you, which then you pay back to the insurance company, which then increases your collateral, which is growing and compounding, which allows you to borrow more, and you rinse and repeat. So you may be asking, how does this work for paying for college? Well, I'm glad you asked. It is the same exact premise. You have money. You pay the insurance company. They hold your dollars as collateral. Then they lend you money for your kid's college. Your kid then becomes a doctor, increases their skill set and market value to the world, which increases their cash flow, which then goes back to the insurance company, which then increases the collateral. Then they can go use that money again for cash flowing producing assets to build more wealth, and then they rinse and repeat. Reason number 3 why life insurance is a better alternative than a 529 plan. Exposure to the market. What happens if your kid does want to go to college and in 2008 happens? Well, I'll tell you what. Bye-bye, Felicia. With the 529 plan, your dollars are typically in mutual funds. Because of that, if your kid is about to go to college and in 2008 happens, your kid's college planning is essentially cut in half. And all that planning was for absolutely nothing. Now, a smart advisor, as we get closer, would typically be a little bit more conservative and take the money from a mutual fund and turn it into cash. But if they do that, you're now missing out on compounding years. See, when someone is younger, they have time for retirement planning. If the market tanks, they have time to let it recover and hold for the future. But in such a short time frame for planning for college, you do not have time to let it recover. In life insurance, it is safe, and once you put $1 in, you never lose that dollar ever again. It has guarantees and is not correlated to the market. Before we dive into the numbers, I'm going to give you 2 last benefits to overfund whole life insurance that you don't get with the 529 plan. The first benefit is money in the life insurance policy is not documented towards FAFSA. So unlike a 529 plan, it does not affect your ability to get money from FAFSA. 2. Life insurance comes with a death benefit. I know it isn't the most exciting thing, especially when we're talking about your kids, but this is how generational wealth is created, passing down wealth from one generation to the next. Last thing as we take a look at the numbers. I never said you would have more money by the age of 18 inside your life insurance plan than a 529. Because in reality, there's a really good chance and likelihood that you will have more money in the 529 plan than overfunded whole life insurance. But what does that actually mean? And what potential problems does that come with? Let's look at the numbers and dive into all 3 points previously discussed. So let's start off with the 529 plan. I'm going to use a 7% return using a future value calculator. The 529 will have a total of $203,994.20. And in the and asset side / overfunded whole life insurance, the policy will have $158,776. Okay, let's now take a look at the numbers for why life insurance could be better. Let's pretend your kid didn't want to go to college. We discussed paying taxes, which would be at an ordinary income rate, let's say 28%. This could be higher or lower per person and also depends on when you watch this. But just ask yourself, do you think rates will be higher or lower in the future? So for taxes, 28% of $203,994.20 equals $57,118.38. But don't forget the 10% penalty, which would be $20,399, which brings us to a total of $126,477 versus the and asset at $158,776, regardless if they went to college or not, with no taxes or penalties. Next, let's look at the lost opportunity costs and the numbers if your kid goes to college. Let's pretend school costs $20,000 per year. This 20K is for illustration examples only. School will be different for everyone, and with inflation, who knows what it'll be. Going to college, the 529 will no longer be getting compound interest, and it is safe to say you wouldn't want to risk this to market exposure while in school. So I am just going to subtract 20K from the total balance every single year, ending with a total of $102,000 after 5 years. So your kid is now graduated from school. The remainder will now be subject to taxes and penalties, leaving you with a total of $83,640 and a kid with a diploma. If we look at the alternative, we will take 20K per year for 5 years and see what it looks like. There are two strategies that we can do with life insurance. One, we can take a withdrawal and take money out of the account just like a 529 plan. So let's start there. So I will take 20K annually from the account, and at the end of 5 years have $85,540. The reason the account didn't just go down by 20K every single year is because this money is still compounding without risk to the market. So the account value is declining from 13K to 16K per year versus 20K per year with the 529 plan. The following year, there are no taxes or penalties. So at year 24, there is a total balance of $89,732. So with this strategy, your kid has a college degree and $89,732 you can use. The last strategy is the most powerful in my opinion, which is taking loans against the policy. I'm not going to try to sugarcoat anything and pretend like there isn't interest being charged on this amount, so I'm going to show you all the numbers. After 5 years of school, the policy now has a loan balance with interest of $117,166 with a total available amount left to borrow of $85,571. The fascinating part about this to me is in all three strategies, your kid has a college degree and roughly the same amount of money available to use, with the draw being the most available. Now, the reason why this strategy is so powerful is because what we did is we never lowered the principal. We used the life insurance company's money. So when we pay the loan back, we still are getting compound interest on the full $212,740 like you see right here. The withdrawal is only getting compound interest on the $94,160 in year 25, and the 529 is no longer a 529 and is now in your bank account getting 0% interest. Lastly, just for contextual purposes, what you will see is that I have added $117,166 to the total balance of the 529 plan and also to the whole life withdrawal plan as well. As you can see, the total amount is $200,806, which is 117 plus 83. And then you could also see that I have done 117 plus 94, which is essentially what is being compounded plus the 117. And I have shown that number because that is what we are getting paid back to the policy with the loan, as you can see here in this example. And in the whole life with the loan, it is just showing that if I pay it back, this is what the full amount is getting compounded on. The numbers speak for themselves. If you want to see the numbers for your specific situation, schedule some time with someone on our team who will be more than happy to help you. Please subscribe to the channel to learn anything and everything life insurance and in the most entertaining way possible.